As global markets dance to the tune of uncertainty, one economy is quietly stealing the spotlight: India. Global investors are rediscovering their appetite for Indian equities, and Jefferies' latest move is a bold testament to that. If its closely watched greed and fear report, Jefferies announced a decisive pivot, trimming Taiwan exposure to go overweight India. Now, it's not just sentiment, it's strategy. According to Jefferies, there are 5 compelling reasons why India's fundamentals are winning hearts on Wall Street. For starters, India's trade exposure to the US remains low compared to peers like Taiwan and South Korea, giving it a cushion against tariff shocks. While the world worries about rising protectionism, India is negotiating a bilateral trade agreement with optimism and quiet confidence. Second reason being the tariffs imposed by the US on India, though high at 26%, are still lower than those on China or Taiwan. There's also talk of easing them further, a sweetener for investors eyeing long-term trade stability. And third, Brent crude prices have dropped 20% year to date, a major boon for oil import-heavy India. Lower oil prices ease inflation, boost fiscal headroom, and even improve the current account. Fourth, global funds that were underweight India are poised to rebalance. But with China's rally cooling and India's earnings looking up, that tide may be turning. And finally, the RBI's shift to an accommodative liquidity stance adds fuel to the fire, with 8.5 trillion rupees in liquidity injections and a surplus position now in place. Bank margins and investor sentiment both get a lift. India is ticking all the right boxes for global capital stability, reform and return. Now, to discuss this further, we earlier spoke with Ajay Bagga, who is a market expert from Mumbai. This was his outlook for the Indian markets going forward. Take a look.
The segments that are attractive to customers, to investors right now, are more domestic oriented, like banks, financials, mutual funds, insurance companies, brokerages. Then we see a lot of focus on consumer durables, industrials, which are building out the India infrastructure story, power, telecom, and real estate. These are the favored sectors. The best way is to go through the fund route and to keep investing regularly and to stay invested for long periods of time. Only the very few great stock pickers are able to pick stocks ahead of their movement. Most of us don't have that facility. So I would say diversify and let compounding magic work for you. Outlook for Indian market is strong. The banks should outperform. The domestic sectors should outperform from here on.